To make it easier to see this presentation, you can maximize your screen by clicking the little box that looks like this. It's in the bottom right-hand corner of your browser. So go ahead and click that icon now, and we will begin reviewing the IRA bailout plan that LionSmart Capital designed specifically for you. Enjoy!
I'm Darren Sugiyama, founder and CEO of LionSmart Capital. So we thought we'd create this custom video for you, going through a strategy that we designed specifically for you and your family, and it's called the IRA Bailout Plan. This plan was specifically designed for folks that have accumulated enough wealth outside of their IRA, where they're really not going to need their IRA funds to retire on. People in that position most likely would just take the RMDs, whether they want to or not. You'd have to take the RMDs out of a traditional IRA. But the real goal was to just let Generation 2 inherit that IRA. The challenge with that is that in most cases, depending on your net worth, those funds will be subject to both estate taxes as well as ordinary income taxes. So the IRA bailout plan is a more tax efficient way to repurpose those funds to maximize the amount that's going to Generation 2. So let's go ahead and get this presentation started. So we're going to take a look at a comparison between three different options you have. Option one is to just do nothing and let the funds accumulate in your traditional IRA and have Uncle Sam take a huge piece of it away from your kids. Now, option two is to do a Roth conversion, where you would pay the income taxes now and let the Roth funds grow tax-free thereafter, and not be subject to any RMDs. And option number three is to roll those IRA funds over into a profit sharing plan that is used to buy life insurance. Now, let's start with evaluating the strategy of doing nothing and just leaving the funds in your traditional IRA. So here's your current IRA value. And for the sake of this hypothetical model, we'll assume this hypothetical net annual return. So based on this assumption, in this column, we have the pre-tax IRA value, which is really kind of a phantom value because it would be subject to income taxes, and it would also be subject to estate taxes. So after the taxes erode the gross value, here we have the after-tax IRA value, which is the real value. Now, you would be required to take RMDs at some point, whether you want to or not, and you'd have to pay taxes on those RMDs. Now, in this example, we're going to show these after-tax RMDs being reinvested in a taxable investment account, growing at the same rate of return as your IRA. We're also going to assume that you have a separate taxable investment account already, and that it's growing at the same net return as the IRA as well. I'll explain why we're showing this separate account in just a bit. So in the far right-hand column, that's the sum of the IRA value in the column above yellow box number 6, plus the RMDs reinvested in a taxable investment account in the column under yellow box number 8, plus the additional taxable investment account in the column under yellow box number 9. Now, again, in the far right-hand column under yellow box number 10, that is what your kids would inherit net after all taxes when they inherit your estate. Now, option two would be to do a Roth conversion. In a Roth conversion, you would roll your traditional IRA value into the Roth IRA, and you would pay income taxes on the full amount immediately. So after the taxes are paid, the Roth would have this after-tax value. Assuming the same net rate of return that we showed in the traditional IRA, but at end of life, the estate taxes will also be due, resulting in this net Roth value. Now, we also have that same additional taxable investment account growing in column 10 here, which I'll explain in just a second. And in the far right-hand column, under yellow box number 8, we have the sum of the columns under yellow box number 6 and yellow box number 7. Option 3 would be to roll over those IRA funds into a profit-sharing plan that eventually buys a premium financed life insurance policy. So here we have your current IRA value, and we would roll that over into a profit-sharing plan. And the first step would be to set up a special purpose LLC, and the legitimate business intent of the LLC is to manage your estate's wealth. Now, you would be the only members in this LLC with no employees other than yourselves. This LLC would be the plan sponsor of a profit sharing plan, and you would then roll over your personal IRA funds into your profit sharing plan with no tax consequence. You would then use those pre tax funds to purchase a life insurance policy inside the profit sharing plan. And then several years later, you would use an irrevocable life insurance trust to buy the policy out of the profit sharing plan at a substantial discount because the IRS safe harbor value of the policy is closer to the cash surrender value of the policy, not the death benefit amount. So this discounted value is a huge benefit to you. Okay, and in the next year, we have a bank inject one more premium into the policy. We call this premium financing. So we took those pre tax funds that were trapped inside the IRA and used them to purchase life insurance that ends up in a trust outside your taxable estate. And at life expectancy, take a look at the net death benefit that your kids would inherit tax free. So let's take a look at all the moving parts and how we arrived at this outcome. So here's the profit sharing plan starting account value. And remember, this is the amount that we rolled over from your IRA. We then use these pre tax funds to purchase life insurance. And in the year following the last premium of your profit sharing plan paid, your irrevocable life insurance trust would buy the policy out of the profit sharing plan. So it's important to note that during this buyout transaction, you need to have outside funds to gift to the trust, and then the trust would use those funds to buy the policy out of the profit sharing plan. It's obviously still your money. It would just now be inside your profit sharing plan instead of one of your current taxable investment accounts. So, if you remember, in the traditional IRA and the Roth IRA examples, we alluded to you having a separate taxable investment account. The reason we showed this is that due to us needing to show where the funds come from to buy the life insurance policy out of the profit sharing plan, it would only be fair to show the same amount being deposited into a taxable investment account in both the traditional IRA and Roth IRA examples. Now, if you'd like a more detailed explanation of this element, please feel free to ask us to explain in more detail in our next meeting. Now, in the next year, once the policy is inside the irrevocable trust, the bank infuses additional premium into the policy. Again, this is called premium financing. And the loan balance, the column attached to green box number 4B, continues as long as you're paying interest only payments to the bank each year. And we see that in the columns attached to green box number 5. And the interest payments are being made by taking drawdowns each year from the remaining value in the profit sharing plan. In the left-hand column, attached to green box number 5, shows the interest rate assumption that we're using in this model. But in a real-world scenario, that interest rate could be higher or it could be lower, and it resets each year in most cases. We work with over a dozen different banks. This is just a hypothetical rate. But down at the bottom of the screen, when we looked at one of our primary bank's loan terms, here's the average borrowing rate over the most recent 30-year period. So in this model, we're showing a borrowing rate that's higher than the historical average, just to be conservative. Now, if you remember, we're paying the interest due by drawing down values from the profit sharing plan in column number 6. Now, you'd pay income tax on these drawdowns, and then the after-tax net amount would be used to pay the interest that we just discussed in the column attached to green box number 5. Once the profit sharing plan is drawn down to a minimum, you could either pay the interest from another source, or in this hypothetical model, we're showing you accrue the interest. Now, assuming this hypothetical annual return in the profit sharing plan, which is the same return we assumed in both the traditional IRA and the Roth IRA, in column 9, we see the pre-tax profit sharing plan's value. But just like the IRA, that value would still be faced with estate taxes and income taxes, resulting in this after-tax account value that your kids would inherit in the column attached to green box number 12. But remember, they would also inherit the life insurance death benefit tax-free here in the column attached to green box number 13. And once we back out the premium financing loan balance and add the remaining after-tax profit sharing plan value, in the far right-hand column, we have the net value that you'd pass on to your kids.
In the blue, we have the traditional IRA with the summary values in years 1, 10, 20, and 30. We have the Roth conversion outcomes in the orange. And in the green, we have our premium finance life insurance policy value plus the profit sharing plan. And if we look closer at life expectancy, we see a pretty dramatic difference between the three options.
So there are a few administrative program fees to set up the LLC, to set up the profit sharing plan, as well as general filing fees. But relative to the tax savings and the increased financial benefit to your kids, these fees are quite nominal. Of course, this was just a brief overview of the platform. And before you make any financial decisions or purchase any type of life insurance product, you should consult with your tax advisor, your attorney, and your trusted financial professionals. But hopefully, this video gave you a good understanding of the basic concept, the platform, and how this may be beneficial to you and your family. The next step would be to have us submit underwriting inquiries to various insurance carriers we work with to see which carrier gives you the best deal. The process is really quite simple. We'll ask you a few health questions over the phone, which will only take about 15 minutes maximum. And then we'll schedule a date and time to have a nurse come to your house and take a blood and urine sample. We then submit all of this information to the insurance carriers, and it will usually take them approximately 6 to 8 weeks to come back to us with a formal offer. If the offer looks worse than what we reviewed in this video, you can walk away at no expense to you. But if the offer comes back as good, if not better than what we reviewed, you have the choice to either take the offer and start the process of having us set up the LLC and profit sharing plan, or you could walk away, again, at no expense to you. So we hope this video was helpful to you, and we look forward to helping you and your family find the right solution for you.